Hello students, welcome to today's episode. Today we will be discussing an important technique of analyzing financial statements. In part 2 we have discussed about 3 techniques: horizontal analysis, vertical analysis, trend analysis. The 4th technique used to understand and analyze financial statement is ratio analysis. I am Dr. Arshia Hussain, teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. So, let us start with the concept of ratio analysis. Ratio analysis has emerged as a principal technique of analysis of financial statements. It is one of the important techniques of analyzing financial statements. A ratio expresses relationship of one figure with any relevant figure. It is defined as one number expressed in relation to another number. An accounting ratio may be defined as a numerical or mathematical relationship between two relevant items contained in the income statement or balance sheet. Now we will see importance of ratio analysis. Ratio analysis as a technique of financial analysis serves the following main advantages. The first one is ratio analysis as a method of financial analysis reduces the huge related accounting figures to a single figure which is easy to understand and remember. Second one is the ratio analysis technique is a better technique as compared to other methods of financial analysis. It reveals the financial position of the company. This helps the investors and lenders in making investment and lending decisions. The third one is the ratio analysis technique is very important to management. It helps management in planning, communication, coordination and control. Accounting ratios help in planning future activities of the business. The ideal ratio may be used for the purpose of comparison and taking corrective action wherever necessary. Fourth one is the management can make inter-firm comparison on the basis of the ratios. Comparisons can be made between the two firms in the same industry or for one firm over a number of years to measure profitability. It helps in locating weak spots of the business and thereby helps the management in taking the remedial measures to correct the situation. The fifth one is ratio analysis helps the management in determining the operating efficiency with which the firm is utilizing its various assets and generating sales revenues, which can be done with the help of activity ratios. Then we will see limitations of ratio analysis. Ratio analysis suffers from many limitations which should be properly recognized by the financial analyst in the computation and application of ratios for interpretation and decision making. Computation of wrong accounting ratios may lead to erroneous results and thereby affecting the future plans of the business. Following are some of the limitations. Number one, the ratio analysis ignores the qualitative factors. Second one, ratios generally diagnoses the problem but fails to provide the solution to the problem. The third one is the ratio analysis is based on historical information since they are based on the financial statements which itself are historical in nature. So, it tells nothing about the future with which the management is specifically concerned. The fourth one is there is no single standard ratio against which the actual ratio is measurable. Circumstances differ from firm to firm and the nature of each industry is different. Therefore, the standard will differ for each industry and the circumstances of each firm will have to be kept in mind. The fifth one is the success of computation and interpretation of accounting ratios basically depends upon the knowledge and experience of the analyst. Thus, interpretation of ratios is a technical and sensitive job which can be performed only by an experienced financial analyst. Sixth one is ratios fail to account for the changes in accounting policies adopted by the firm. Such changes may be relating to depreciation policies, inventory valuation policy, treatment of foreign exchange transactions and so on. Seventh is ratio analysis on its own will never be able to look into window dressing, if any, in the financial statements. Eighth one is ratios are also subject to misinterpretation. For instance, a higher current ratio signifies a better and sound financial position of the firm. So, a firm is striving for this may approaches the inefficient use of the resources of the firm. Now, we will see types of ratios. We will discuss the various types of ratios used to analyze financial statements. The first one is activity ratios, the second one is profitability ratios, then we have leverage ratios, and the fourth one is liquidity ratios. We will be discussing each of these ratios one by one. The first one is activity ratios. Activities ratios are used to measure the effectiveness with which a concern uses its resources. It is also known as turnover ratios as it reflects the extent with which the assets are converted into sales. The business would be more profitable if greater turnover is achieved with lesser use of funds. In other words, a high turnover ratio indicates a better use of capital or resources. The important activity ratios are capital turnover ratio, fixed assets turnover ratio, working capital turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio. Now, we will be discussing each of these ratios in detail. The first one is capital turnover ratio. Now, capital turnover ratio establishes a relationship between net sales and capital employed. This ratio determines the efficiency with which capital employed is being used in the business. A high capital turnover ratio is considered to be favorable as it indicates higher profits. However, a very high ratio is a sign of overtrading, which can lead to scarcity of funds. This ratio is calculated as capital turnover ratio is equal to net sales divided by capital employed. Now, where net sales is equal to sales minus sales returns and capital employed is equal to shareholders funds plus long term debts. Now, we will see one illustration on this. Calculate capital turnover ratio from the following. What is given to us is the fixed assets rupees 1,20,000, then we have working capital rupees 60,000, cost of goods sold for rupees 6 lakhs, gross profit rupees 1,20,000. Now, we will have a look at the solution. We know that capital turnover ratio is equal to net sales upon capital employed, that is rupees 7,20,000 divided by rupees 1,80,000. So, which gives us 4 times. Now, the another type of ratio we will see is fixed assets turnover ratio. Fixed assets turnover ratio shows how efficiently the fixed assets are being utilized in the business. A high ratio indicates a better performance. On the other hand, a low ratio indicates that fixed assets are not being efficiently utilized. This ratio is calculated as fixed assets turnover ratio is equal to sales divided by fixed assets. Now, we will see one illustration on this ratio, that is calculate fixed assets turnover ratio from the following. Shareholders funds rupees 5 lakhs, long term debts rupees 3 lakhs, working capital given to us is rupees 2 lakhs. Sales we have for rupees 12 lakhs. Now, the solution for this is we know that fixed assets turnover ratio is equal to sales divided by fixed assets. So, fixed assets is equal to capital employed minus working capital, thus which is equal to rupees 5 lakhs plus 3 lakhs minus rupees 2 lakhs, which is equal to rupees 6 lakhs. So, therefore, fixed assets turnover ratio is equal to 12 lakhs divided by 6 lakhs, which is equal to 2 times. Now, the another ratio is working capital turnover ratio. This ratio indicates the speed with which working capital is turning over into sales or is turned over into sales. In other words, it determines the efficiency with which the working capital has been utilized in the business. Working capital is calculated as working capital turnover ratio is equal to net sales divided by net working capital, where net sales is equal to gross sales minus sales returns. Working capital is equal to current assets minus current liabilities. Now, we will see one question on this. Calculate the working capital turnover ratio from the following. Sales given to us is rupees 2 lakhs, current assets rupees 1 lakh, current liabilities rupees 75,000, sales returns given to us is rupees 25,000. Now, we will see the solution to this question. Working capital is equal to current assets minus current liabilities, which is equal to rupees 1 lakh minus rupees 75,000, which is equal to rupees 25,000. Now, net sales is equal to rupees 2 lakhs minus rupees 25,000, which is equal to rupees 1 lakh 75,000. So, thus the working capital turnover ratio is equal to net sales divided by net working capital, which is equal to rupees 1 lakh 75,000 divided by rupees 25,000, which is equal to 7 times. Now, we will see another ratio, which is stock turnover ratio. The stock turnover ratio measures the relationship between the cost of goods sold during a given period and the average amount of stock or inventory carried during that period. This ratio determines the efficiency with which the stock is utilized. It indicates the speed with which the stock is turned over into sales. This ratio is calculated as a stock turnover ratio is equal to cost of goods sold divided by average stock, where cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock, or cost of goods sold is equal to sales minus gross profit. Average stock is equal to opening stock plus closing stock divided by 2. Now, higher the ratio, better it is for the firm, since it indicates that more sales are being produced by a rupee of investment in stocks. A high stock turnover ratio implies a better inventory management. On the other hand, a low turnover ratio indicates the accumulation of obsolete stock which is not saleable. Now, we will see one more question. Calculate the stock turnover ratio from the following. Cost of sales rupees 4,50,000, stock at the beginning of the year rupees 1,25,000, stock at the end of the year rupees 1 lakh. Now, we will see solution to this question. The stock turnover ratio is equal to cost of goods sold divided by average stock. Cost of goods sold is equal to opening stock plus purchases minus closing stock. Thus, we have rupees 60,000 plus rupees 3,30,000 minus rupees 3 lakhs, which gives us rupees 90,000. Now, we will see what is average stock. Average stock is equal to opening stock plus closing stock divided by 2. That is rupees 60,000 plus rupees 90,000 divided by 2, which is equal to rupees 75,000. So, the stock turnover ratio is equal to cost of goods sold divided by average stock, which is equal to rupees 3 lakhs divided by rupees 75,000. So, thus the stock turnover ratio is 4 times. Now, we will see one more question. Calculate stock turnover ratio with the help of the following figures. We are given with the trading account for the year ending 30th March 2020. The particulars given to us are, on the left hand side, which is the debit side, we have to opening stock rupees 60,000, to purchases rupees 2 lakhs, to wages rupees 50,000, to gross profit rupees 2,30,000. Now, on the credit side, that is the right hand side, we have by sales 5 lakhs, by closing stock 40,000. The total of all this is 5,40,000. Now, we will see solution to this. Stock turnover ratio is equal to cost of goods sold divided by average stock, which is equal to rupees 2,50,000 divided by 50,000. So, thus stock turnover ratio is equal to 5 times. Now, the another ratio is debtors turnover ratio. Debtors turnover ratio establishes the relationship between the net credit sales and average debtors of the year. Average debtors are calculated by dividing the total debtors in the beginning and at the end of the year by 2. Now, this ratio is used to test the efficiency or speed with which the debtors are converted into cash. A high ratio is considered as favorable since it indicates a successful credit policy. This ratio is expressed in number of times. This ratio is calculated as follows: debtors turnover ratio is equal to net credit sales divided by average debtors. Now, we will see one more question on this ratio, that is, calculate debtors turnover ratio from the following. Gross sales given to us is rupees 8 lakhs. Debtors in the beginning is rupees 75,000. Debtors at the end is given to us for rupees 1,25,000. Then we have sales returns for rupees 50,000, cash sales for rupees 1,50,000. Now, let us see solution to this question. Debtors turnover ratio is equal to net credit sales divided by average debtors. Now, credit sales is equal to gross sales minus cash sales, which is equal to rupees 8 lakhs minus 1,50,000. Thus, we have 6,50,000. So, net credit sales is equal to credit sales minus sales returns. Now, credit sales are of rupees 6,50,000 minus rupees 50,000, which gives us rupees 6 lakhs. Thus, average debtors is equal to rupees 75,000 plus 1,25,000 divided by 2, which is equal to rupees 1 lakh. So, the debtors turnover ratio is equal to rupees 6 lakhs divided by rupees 1 lakh, and hence the debtors turnover ratio is equal to 6 times. Now, we will see creditors turnover ratio. This ratio shows the relationship between net credit purchases and average trade creditors. It determines the efficiency or speed with which the payments for credit purchases are made to the creditors. A high credit turnover ratio implies earlier payments to the creditors, and a low ratio indicates a delayed payment. This ratio may be calculated as creditors turnover ratio is equal to net credit purchases divided by average trade creditors. Let us see one question on this ratio. Calculate creditors turnover ratio from the following: net credit purchases for rupees 1,20,000, then creditors in the beginning of the year rupees 33,000, then creditors at the end of the year rupees 27,000. Now, we will have a solution for this. Creditors turnover ratio is equal to net credit purchases divided by average creditors, which is equal to rupees 1,20,000 divided by rupees 30,000, which is equal to 4 times. Now, we will discuss the next financial ratio, that is profitability ratios. Now, profitability ratios measure the effectiveness of the overall management. In other words, it measures profits in relation to sales or capital employed. It indicates the overall efficiency of the management. Following ratios are calculated to measure the profitability of a concern. First one is gross profit ratio, second is net profit ratio, the third one is operating profit ratio, and the fourth one is operating ratio. So, let us discuss each of these ratios one by one. The first one is gross profit ratio. Now, gross profit is defined as the profit before the recovery of operating expenses. It is the difference between the sales and cost of sales. The gross profit is directly related to sales, as it directly varies with the volume of sales, if cost of sales remains the same. The gross profit ratio is computed by using the following formula. Gross profit ratio is equal to gross profit divided by net sales multiplied by 100. Higher the ratio, the more efficient is the production. We will see one question on this. A businessman carries an average stock of rupees 80,000. His stock turnover ratio is 8 times. If he sells goods at a profit of 20% on sales, find out his profits. Now, we will see solution to this question. A stock turnover ratio is equal to cost of goods sold divided by average stock. So, we have 8 is equal to cost of goods sold divided by rupees 80,000. Now, cost of goods sold is equal to rupees 6,40,000. Gross profit being 20% on sales or 25% on cost is equal to rupees 1,60,000. So, thus sales is equal to rupees 8 lakhs. Now, we will see another ratio, which is net profit ratio. Now, this ratio is very useful to the proprietors and prospective investors because it reveals the overall profitability of the concern. This is the ratio of the net profit after taxes to net sales. Net profit ratio is calculated by using the following formula. Net profit ratio is equal to net profit divided by net sales multiplied by 100. Higher the ratio, the greater is the capacity of the firm to withstand adverse economic conditions. Now, we will see one question on this. Calculate the net profit ratio from the following. Net sales given to us for rupees 3,50,000. Purchases is rupees 80,000, then cost of goods sold for rupees 2 lakhs, office and administrative expenses rupees 40,000, selling and distribution expenses rupees 35,000, then interest on debentures rupees 30,000. Now, we will see solution to this question. Gross profit is equal to net sales minus cost of goods sold. So, we have rupees 4 lakhs minus rupees 2 lakhs, which is equal to rupees 1,50,000. Now, net profit is equal to gross profit minus office and administrative expenses minus selling and distribution expenses minus interest on debentures, which is equal to rupees 1,50,000 minus rupees 40,000 minus rupees 35,000 minus rupees 30,000, which is equal to rupees 45,000. Now, we know that net profit ratio is equal to net profit divided by net sales multiplied by 100. So, the net profit ratio is equal to 11.25%. The next type of ratio is operating profit ratio. This ratio measures the relationship between operating profits and net sales. This ratio is computed to determine the operating efficiency of the management. It can be calculated. Operating profit ratio is equal to operating profit divided by net sales multiplied by 100. Higher the ratio, the more efficient is the operating management. Now, the next type of ratio is operating ratio. Operating ratio measures the relationship between the cost of goods sold plus other operating expenses to net sales. Operating ratio may be calculated as operating ratio is equal to operating cost divided by net sales multiplied by 100. Operating cost comprises of first cost of goods sold and other operating expenses minus cost of goods sold and administrative expenses, selling and distribution expenses, then interest on short term loans, discount allowed and bad debts. Net sales is equal to gross sales minus sales returns. Now, operating ratio is useful in comparing the operational results of the same firm for more than 1 year. It is also useful for inter-firm comparisons. Operating ratio is equal to operating cost divided by net sales multiplied by 100, or operating ratio is also equal to cost of goods sold plus operating expenses divided by net sales multiplied by 100, where cost of goods sold is equal to opening stock plus purchases plus direct expenses plus manufacturing expenses minus closing stock. Now, let us see one question on this. Calculate operating ratio from the following. Cost of goods sold is equal to rupees 5,60,000, operating expenses is equal to rupees 80,000, sales is equal to rupees 8,40,000, sales returns is equal to rupees 40,000. Now, we will see solution to this. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales multiplied by 100, which is equal to rupees 5,60,000 plus rupees 80,000 divided by rupees 8 lakhs multiplied by 100, which is equal to rupees 6,40,000 divided by rupees 8 lakhs multiplied by rupees 100. So, thus operating ratio is equal to 80%. Now, the next type of ratio is expenses ratio. The firm calculates various types of expenses ratios in order to measure its operational efficiency. For this purpose, the following ratios may be computed. The first one is materials consumed ratio. It indicates the efficiency in utilizing the raw material. It is calculated as follows. Materials consumed ratio is equal to materials consumed divided by net sales multiplied by 100. The second is administration expenses ratio. This ratio indicates the efficiency in the incurrence of administrative expenses. It is calculated as follows. Administrative expenses ratio is equal to administrative expenses divided by net sales multiplied by 100. Then the third one is selling and distribution expenses ratio. This ratio indicates the efficiency in the incurrence of selling and distribution expenses. It is expressed as a percentage. This ratio is calculated as follows. Selling and distribution expenses ratio is equal to selling and distribution expenses divided by net sales multiplied by 100. We will see one question on this. Sigma Enterprises has drawn up the following profit and loss account for the year ended 31st March 2020. We are given the statement as particulars for debit side and the particulars on the credit side. To opening stock 26,000, then we have to purchases 80,000, then we have to wages 24,000, to manufacturing expenses we have 16,000. Sales given to us is 1,60,000, closing stock given to us is 38,000. So with this we have a gross profit for rupees 52,000. Then we have selling and distribution expenses 4,000, then administrative expenses 22,800, general expenses 1,200, cost of furniture, lost by fire 800, interest on debentures given to us is 6,000. Then we have to provision for taxation 8,000. Then on the right hand side, which is the expenditure side, is gross profit we have 52,000. Then by compensation for acquisition of land is 4,800. The total for this is 56,800. Now by balancing we get a net profit for rupees 14,000. You are required to calculate the gross profit ratio, net profit ratio, operating profit ratio and operating ratio. Now we will see solution to this. The first one is gross profit ratio. Gross profit ratio is equal to gross profit divided by net sales multiplied by 100, which is equal to rupees 52,000 divided by rupees 1,60,000 multiplied by 100, which is equal to 32.5%. The second one we will have to calculate is operating profit ratio. Operating profit ratio is equal to operating profit divided by sales multiplied by 100. Operating profit we know it is equal to gross profit minus operating expenses, which is equal to rupees 52,000 minus within bracket rupees 4,000 plus rupees 22,800 plus rupees 1,200, which is equal to rupees 24,000. So thus operating profit ratio is equal to rupees 24,000 divided by rupees 1,60,000 multiplied by 100. The third one we have to calculate is the net profit ratio. We know net profit ratio is equal to net profit upon sales multiplied by 100, which is equal to rupees 14,000 divided by 1,60,000 multiplied by 100, which is equal to 8.75%. The fourth type of ratio that we are to calculate is the operating ratio. Operating ratio is equal to total operating cost divided by sales multiplied by 100. Now, total operating cost is equal to rupees 26,000 plus rupees 80,000 plus rupees 24,000 plus rupees 16,000 plus rupees 4,000 plus rupees 22,800 plus rupees 1,200 minus rupees 38,000. Which is equal to rupees 1,36,000. So thus operating ratio is equal to rupees 1,36,000 divided by rupees 1,60,000 multiplied by 100. Now we will discuss one more type of ratio, that is profitability ratios in relation to investment. Under this we have the following types of ratios. The first one is return on capital employed, the second one is return on equity, the third one is return on equity shareholders funds, and the fourth one is earning per share, that is EPS. Now the first ratio is return on capital employed. This ratio measures the overall performance of the business enterprise. This ratio measures a relationship between net profit before interest and tax and capital employed. Capital employed includes share capital, that is equity as well as preference share capital. Reserves, profit and loss account, which is credit balance, and long term loans less fictitious assets like preliminary expenses, underwriting commission and non-operating expenses like investments. Now, this ratio is calculated to find out how efficiently the long-term funds supplied by the creditors and shareholders have been used. In other words, it helps in determining the efficiency of the management in utilizing the capital employed. Now, this ratio is calculated as return on capital employed is equal to net profit before interest and tax divided by capital employed multiplied by 100. Higher the ratio, the more efficient the management and utilization of capital employed. Now, let's see one question on this. Compute return on capital employed on the following. Net profit after tax rupees 43,000, income tax rate is 50%, then 14% debentures are for rupees 1 lakh, share capital rupees 2,50,000, profit and loss account rupees 1,58,000, then we have loss on issue of debentures which is for rupees 8,000. Now, we will see solution to this. Return on capital employed is equal to net profit before interest and taxes divided by capital employed multiplied by 100. So, net profit after tax is for rupees 43,000. Taxation at the rate of 50% we have is rupees 43,000. Then net profit before tax is equal to 86,000. Then debenture interest is equal to rupees 14,000. So, net profit before tax and interest is equal to rupees 1 lakh. 14% debentures rupees 1 lakh, share capital rupees 2,50,000, profit and loss account rupees 1,58,000 divided by 5,08,000 less loss on issue of debentures, that is rupees 8,000. So, capital employed is equal to rupees 5 lakhs. Capital employed is equal to 5 lakhs. Return on capital employed is equal to net profit before interest and tax divided by capital employed multiplied by 100, which is equal to 1 lakhs divided by rupees 5 lakh multiplied by 100, which is equal to 20%. Now, the next ratio is return on equity. This ratio measures the relationship between net profit after interest and tax and shareholders' funds. It indicates the firm's ability to generate profit per rupee of shareholders' funds. This ratio is computed as follows. Return on equity is equal to net profit after interest and tax divided by shareholders' funds multiplied by 100. Higher the ratio, the more efficient the management and utilization of shareholders' funds. Calculate return on equity, that is ROE, from the following. 10% preference share capital given to us for rupees 12 lakhs. 15,000 equity shares of rupees 10 each is given to us for rupees 1,50,000. Then we have reserves and surplus for rupees 5,50,000 and net profit after tax is given to us for rupees 2,37,500. Now, the solution to this question is return on equity is equal to net profit after interest and tax divided by shareholders' funds multiplied by 100, which is equal to 2,37,500 divided by 9 lakhs multiplied by 100, which is equal to 26.38%. Next, we will discuss return on equity shareholders' funds. This ratio measures the relationship between net profit after interest, preference dividend and income tax and equity shareholders' funds. This ratio is computed to find out how efficiently the funds supplied by the equity shareholders have been used. The formula for calculating this ratio is return on equity shareholders' funds is equal to net profit after interest, tax and preference dividend divided by equity shareholders' funds multiplied by 100. Now, next ratio is earning per share. Earning per share, that is EPS, is computed by calculating the profit after tax and preference dividend and dividing the same by the number of shares outstanding. Thus, EPS is equal to profit after tax and preference dividend divided by number of equity shares outstanding. We will see one question on this. Calculate EPS from the following. Net profit before tax rupees 2 lakhs, then 10% rupees 2 lakh preference shares of rupees 100 each, rupees 2 lakh equity shares of rupees 10 each, tax rate is 50%, Now, we will see solution to this question. Earning per share is equal to net income minus preference dividend divided by number of equity shares, which is equal to rupees 80,000 divided by 20,000, which is equal to rupees 4. That is, EPS is equal to rupees 4. Now, we will see some working notes. Net profit before tax rupees 2 lakhs, less tax at the rate of 50%, which is rupees 1 lakh. Net profit after tax rupees 1 lakh, less preference dividend, which is rupees 20,000. Net income is rupees 80,000. So, that is all for today. Hope you have understood the activity and profitability ratios. So, we will meet in the next session with the remaining two ratios, that is liquidity ratios and leverage ratios, in the next week.